Hello guys. So today we will discuss CMA Final Group 4 Corporate Financial Reporting Paper 17. Under that AS 22 Accounting for Taxes on Income. Okay. So what is this accounting for taxes on income? So you take the Schedule 3 of financial statement. Schedule 3, all of you must be aware about Schedule 3. You have this income statement, P&L account and balance sheet. It is prepared, lot of items, revenue from operations, and you have expenses like salaries, employee cost, depreciation, all other things. Finally, you will get net profit. Thereafter, taxation. You have two types of taxes. One is current tax and other one is deferred tax. Fine. So this is your schedule 3. So under this schedule 3 you have this current tax. Current tax means tax calculated for the particular period. So how this tax is calculated actually? Provision for tax. That current tax may be your provision for tax also. How this tax is calculated? Whether this is calculated on profit available, profit prepared as per the generally accepted accounting principle, net profit as per the generally accepted accounting principle, or the tax, current tax, provision for tax is calculated on the basis of tax net profit as per the Income Tax Act. So current tax, this provision for tax is basically prepared based on the net profit as per the Income Tax Act. Net profit as per the Income Tax Act, that is taxable income as per the Income Tax Act, not as per the generally accepted accounting principles. Hope all of you are aware about business or profession. Under the Income Tax Act, one of the main head is business or profession. Under that you would have solved a lot of problems in inter level, maybe in final level also. The one of the problem is like net profit as per P&L account, that will be the opening balance. Then we will do lot of adjustment by adding and deducting. Add all the allowed expenses, deduct all the disallowed expenses. Finally you will get net profit as per Income Tax Act. On that we have to calculate taxation. Correct? That tax only is current tax. That tax only is current tax. Okay. Then we know about current tax. This is basically the calculated based on the taxable income. Then if you go through the schedule 3, next to the current tax, you have deferred tax. You have deferred tax. Then what is the job of deferred tax? What is the job of deferred tax? So deferred tax is a tax we are accounting due to the timing difference. Due to the timing difference between the Income Tax Act and the generally accepted accounting principles. Why? Because if you take one example, depreciation you take. So under the financial statement schedule 3, the depreciation is calculated as per the Companies Act. Depreciation is calculated as per the Companies Act. Whereas depreciation, you have a separate chapter in Income Tax Act also. Depreciation, you have a separate topic in Income Tax also. So the depreciation rate is different from the depreciation rate calculated under the Companies Act. Depreciation rate under the Income Tax Act is different from depreciation rate available in the Companies Act. Correct or not? So because of this reason, my net profit under the Companies Act or net profit under the generally accepted accounting principle will not be same normally it will not be same compared with your taxable income. So accounting income is an income which is arrived by following generally accepted accounting principles. Taxable income is the income which is arrived by following the Income Tax Act. I will pay tax based on the taxable income, and that whatever I calculated as a tax income I should account in my financial statement. Okay. So because of this reason, matching concept is not followed. Because of this reason, the matching concept is not followed because of this current tax. Why? Because my profit, as per my books of accounts, my profit will be 100 crores. As per my books of accounts, that is my accounting income, profit will be 100 crores. Okay, assume rate of tax is 30%. Assume rate of tax is 30%. Then how much I will pay? 30 crores I will pay. 100 into 30, 30%, 30 crores actually I have to pay. But because of this income tax act, and there is a different provisions available under the income tax act, my profit becomes 120 crore. My profit becomes 120 crore. 120 crore into 30% how much? 36 crores. Actually I have to pay 30 crores only, but I am paying 36 crores because of provision difference, because of the accounting effect due to the provision difference. Okay, lot of allowances, disallowances available under the income tax act. For that reason I may pay more or I may pay less for the current period. But this paying more or paying less will be adjusted in subsequent years. Correct or not? Because this year I will pay more means next year I will pay less, maybe. Because all the 100% expenses claimed in the first year itself, depreciation 100% provided in the first year itself. Next year I will not provide anything in my income tax account. In my under the income tax act, I will not provide anything next year. That means next year I will have more profit. This year I will have less profit. For that reason I will pay less in first year. I may pay more in the next year because there is no depreciation available in the next year. Expenses is reduced. So because of this reason only the deferred tax concept is introduced. That is basically matching concept. Based on the matching concept only this deferred tax is introduced. Why? Because for actually what is my profit, for that I have to create the liability, tax liability. If my profit actually will be 100 crore means I have to create a liability of 30 crore. Because of this income tax allowance and disallowance and I am not able to match my tax versus profit correctly. Correct? So that is why AS 22 is introduced. We will go to the topic now. So AS 22, accounting for taxes on income. CMA final group 4 paper 17, corporate financial reporting. So in this topic, so just now I discussed with you accounting income. What is this accounting income? This is net profit or loss for a period reported in statement of P&L before reducing tax expenses or adjusting income tax savings. So before provision for taxation, profit before tax. This is nothing but profit before tax prepared as per the generally accepted accounting principles. Okay, accounting income. Following the GAAP, I prepared this profit before tax. And what is the next one? Taxable income. Do you think accounting income and taxable income will be having the same meaning? No, definitely no. Accounting income is based on the preparation by following generally accepted accounting principle and accounting standards also. Whereas taxable income is prepared based on the provisions followed in Income Tax Act, and also you have a separate accounting standards available in Income Tax Act actually. That also I would have followed. So taxable income is basically the amount of income or loss for a period arrived as per income tax laws on which tax payable or receivable is determined. So taxable income is calculated as per the Income Tax Act. Okay, on that taxable income only I will calculate my tax amount. Okay, go to the next slide. So tax expenses or savings. Under that This is nothing but Schedule 3 breakup. Schedule 3, you have the total tax includes two elements. One is current tax and another one is deferred tax. The total of current tax and deferred tax debited or credited to statement of profit and loss for the period. Okay. What is this current tax? Just now I discussed. Current tax is tax nothing but calculated based on the income tax provisions. Current tax is calculated based on the income tax provisions. So the amount of income tax payable or receivable determined on taxable income or loss for a period. The taxable income is calculated based on what? Income tax provisions. Okay. Then MAT, minimum alternative tax. I hope all of you having some basic idea about MAT. Okay. Again, this MAT amount is also calculated on following which act? MAT is calculated on following Income Tax Act only. Okay. It is like under the MAT we may pay more for the first year. Next year that whatever you paid more can be adjusted with the income tax amount. You should have some basic idea about MAT. I am not going to discuss what is MAT. So MAT is also calculated as per the Income Tax Act. Okay. So your current tax expenses includes tax calculated as per the Income Tax Act as well as tax calculated under the MAT. Okay. Then come to the topic that is relevant to AS 22, that is deferred tax. This AS 22 purpose is basically for deferred tax. Okay. To adhere the matching concept, accounting the tax effect on financial statement due to timing difference between accounting income and taxable income. You got it or not? I am preparing Schedule 3, I am preparing financial statement. That is based on what? That is based on generally accepted accounting principles. Based on generally accepted accounting principles, I arrived my profit. But the provision for tax, current tax is not arrived based on my generally accepted accounting principles. That current tax is arrived based on the income tax provision. Current tax is arrived based on the income tax provision. Because of that, there is a mismatch of tax. Compared with my profit. So to set off this mismatch, I am introducing deferred tax. After introduction of deferred tax, I am able to match my tax with my relevant profit. That is why deferred tax is introduced. This is not an actual payment of tax. This is book adjustment. Deferred tax is merely a book adjustment because of reason that I want to show the correct profit after tax available to shareholders by introducing the deferred tax. Okay. That is why it is mentioned as to adhere the matching concept. Matching concept means what is my profit on which this is my tax. After my tax, this is my profit. The tax includes actual tax, that is current tax, as well as deferred tax. Deferred tax is a booking expenses or income. Okay, there is no actual outflow or inflow on deferred tax. Only to match the profit versus tax, this deferred tax is introduced. That is why it is to adhere the matching concept, accounting the tax effect on financial statement due to timing differences between accounting income and taxable income. Okay. We will work out the problem, we will understand. For the time being, you should able to know the basic meaning of deferred tax. Why this is deferred tax is introduced? What is the purpose? Already we have current tax, then why additionally deferred tax is introduced? Because of the reason that there is a mismatch between your profit versus tax due to tax is prepared based on your Income Tax Act, whereas profit is prepared based on the generally accepted accounting principles. Under the Income Tax Act, you have a lot of allowances, disallowance, due to which your profit is changed, on which you are paying tax, but you are presenting under the Schedule 3, which is prepared under the generally accepted accounting principle, due to which there is a mismatch. That mismatch is set off against by introducing the deferred tax. Okay. So the next thing is Deferred tax is the tax effect due to timing difference. Timing difference means what? Timing difference means this year I will not account any expenses. Next year only I will account it as an expenses. Or this year I will under the income tax act, this year fully I will allow expenses. 100% expenses is allowed in first year itself. 100% depreciation is allowed in the first year itself. Next year no depreciation. That is timing difference. Okay. So this timing difference should be properly eliminated by introducing the deferred tax. Okay. So timing difference arise due to following reasons. So deferred tax will be arise due to timing difference when what are the scenario? At what scenario this things will be arrived? First thing is accounting income is less than taxable income. Accounting income, my net profit under the P&L account is 100 crore, but my net profit as per the income tax act is 150 crore. You got it? That is accounting income is less than taxable income. Actually my profit is book profit is net profit as per the P&L account is 100 crore only, but my net profit as per income tax act is 150 crore. Because of this deferred tax situation may arise. Because 100 into 30%, 30 crores. 100 into 30% how much? 30 crore. But 150 into 30% how much? 45 crore. Actually I have to pay 30 crore only, but I am paying 45 crore because of the income tax act provisions. Because of the income tax provisions there is a timing difference arised, due to which I am paying more. Okay. Accounting income is more than taxable income. Maybe this way. As per my net profit as per financial statement is 100 crore. But taxable income, my net profit as per income tax act is only 50 crore. So I am paying less tax. Actually I have to pay more tax, I am paying less tax. Because 100 into 30%, 30 crore. 50 into 30%, 15 crore only. Actually I have to pay 30 crore, but I am paying only 15 crore. Because of the income tax provisions. Because of the income tax provisions. Okay. Because of the timing difference in the accounting the expenses. Because of the timing differences in the accounting the expenses. Okay. Likewise, income as per accounts but loss as per IT Act. Loss as per accounts but income as per IT Act. This scenario I may create deferred tax. All these scenarios I have to create the deferred tax. That may be a deferred tax asset or that may be a deferred tax liability. Okay. Then you have two types of differences actually. You have two types of differences. Differences between accounting income and taxable income for a period. So there is two types of differences will come under the income tax act and the gap. Okay. So permanent difference. What is this permanent difference? What is this permanent difference? Permanent difference means, say for example, there are some expenses. There are some expenses which will be disallowed. Which will be disallowed. Once it is disallowed means it will not be allowed again. You can't take the allowance again. Okay. That means permanent disallowance. Permanent disallowance. For example, cash expenses under section 40A subsection 3. If I make cash expenses more than 10,000 rupees, then that expenses is disallowed. You got it or not what I am saying? That is permanent difference. Permanent difference means under the income tax act, this expense is not at all allowed. Why? Because provisions, rules and regulation. Rules and regulation is not followed. Okay. So why this permanent difference is discussed here? So this direct deferred tax asset or liability should be created only for the timing difference. This deferred tax assets and or liability should be created only for the timing difference, not for permanent difference. Permanent difference means you will not provide any tax for that amount. You will not provide, you are going to eliminate that amount. Whether it is an income or expenses, you are going to eliminate that amount from the your calculation of taxable income. You got it on what I am saying? You can say, sir, that is allowed as an expenses under the financial statement, but that is not an expenses under the income tax act. Then we are preparing only for deferred tax is prepared only for the purpose of showing in financial statement only. No, like that you should not ask, because permanent difference means that expenses is disallowed. Basically, the tax arised only based on the Income Tax Act. Tax is for Income Tax Act only. Even if that Income Tax Act itself denying the amount, they are saying they are disallowing this amount means, then we should ignore that amount. For permanent difference, we should not create any DTA, deferred tax asset or liability, in the books of accounts. We will understand what is deferred tax asset, deferred tax liability. For the time being, what is permanent difference you should understand. Permanent difference means that is permanently disallowed or ignored from the Income Tax Act. That item is you should not consider while preparing the deferred tax asset or liability. Okay, one of the examples, cash expenses. You paid more than 10,000 rupees cash expenses, then it is disallowed. You cannot treat it as an expenses in Income Tax Act. The same should be disallowed. The same should be ignored in preparing the deferred tax also. Got it? That is permanent difference. So what is given here? Permanent difference explanation is differences arrived in one period and should not be reversed subsequently. Okay, meaning it is permanently disallowed. So if there is a reversal effect, then only DTA is created. If there is a reversal effect, then only DTA is created. So in case of permanent difference, there is no reversal, so no DTA or DTL is allowed. TTL is allowed. Okay. So then what about the next one? Timing or temporary difference. This is what required for us. This is what the required for us. What is this timing or temporary difference? As I said, one of the example I gave you, this year 100% depreciation means next year no depreciation. Okay, that is one example. Or else there are some expenses under section 43B. Under section 43B, under the Income Tax Act, they are saying only if you make actual payment. Only if you make actual payment, then only you will consider as an expenses for that particular period. Otherwise, when you are paying, no, that year only it is considered as an expenses. Meaning provision is not allowed. Provision for expenses is not allowed for these expenses under section 43B. Only actual payment is allowed. If you don't pay within the financial or within the due date of filing the income tax return, then your expenses is disallowed. Okay, you are paying in next year, then next year it is allowed as an expense. So first year disallowed expenses, next year only it is allowed. These are the things as called as a temporary or timing difference. Temporary or timing difference. Timing difference. This year it is not allowed, next year it is allowed. So next year there will be an effect. This year only there is no effect. All these things are timing difference. For this item only we have to provide the DTA or DTL. That is deferred tax asset or deferred tax liability. Okay. So what is the language used here? Just go through. Timing or temporary differences. Differences arrived in one period and needs to be reversed in one or more subsequent period. This year something is happening and next year it is adjusted. Okay. This year due to Income Tax Act I did not provided the expenses. I did not consider the expenses. Next year I am considering the expenses. Accordingly I have to create DTA or DTL. Okay. In first case of permanent differences, no DTA or DTL. In case of timing or temporary differences, we have to create DTA or DTL according to the nature of item. Okay. So this is what given. Examples, depreciation is given, interest paid, all those things is given. Go to the next slide. What is the next thing? How to account deferred tax due to timing differences. That is the next thing, next question. Now you know what is deferred tax, correct? Deferred tax is generally created, for the purpose of timing differences between GAAP and Income Tax Act. GAAP and Income Tax Act, due to which certain item is accounted as an expenses, certain item is not accounted as an expenses. Then later on it is accounted as an expenses. Later on it is not accounted as an expenses. For that reason we are creating the deferred tax. Okay. How to account deferred tax due to timing differences. So we have to identify nature of item first of all. That is what given here. Identify, classify and quantify each item falls under timing differences. The outcome will be either original, that is initial timing differences, first time occurrence, or reversing timing differences already occurred and now getting reversed. So what they are trying to say, first you identify what is the nature of item, whether it is allowed fully or whether it is not allowed. For example, 43B, under section 43B, only if you make payment then only it is allowed, otherwise it is not allowed, correct? That is one type of thing. Okay, so we have to identify whether it is coming under the deferred tax asset category or whether it is coming under deferred tax liability category. That we will understand what is deferred tax asset, what is deferred tax liability, and also originating timing differences and reversing timing differences. What is this originating timing differences? So this originating timing differences is basically, first time impact on the item because of provision. First time impact on the item because of the income tax provision. First time only this will happen. Next time and all subsequently we have to do the reversal effect. That is called reversing timing differences. That is already occurred and now getting reversed. First time I did something, that is originating timing differences. Next time I have to give the opposite effect. Next time I have to give the opposite effect. That we will work out the problem, you will understand what is this OTD and RT, that is reverse timing differences. Originating timing differences OTD and reversing timing differences RTD. We will understand by working out the problem. So what they are saying, in the year of initial timing differences, whether a tax liability is postponed or paid in advance. First of all, that is originating timing differences. In the year of originating timing differences, we have to understand whether we are paying more or whether we are paying less. Whether we are paying more or whether we are paying less under the Income Tax Act. Okay. So that is what they said here. Identify whether tax liability is postponed or paid in advance. Whether tax liability is postponed or paid in advance. Next thing, if the tax liability is postponed, an amount equivalent to such tax liability should be debited to P&L account and deferred tax liability account is created. Meaning and everything we will understand by working out the problem. Deferred tax liability, how to create, how to account we will understand. That is save now and pay later. Save now and pay later means under the Income Tax Act I am paying more. Next if subsequent year I will pay less. Under the Income Tax Act I am paying more in the present year. In future years I will pay less. Okay. So again I am reading the third bullet point. There is small correction. So if tax liability is postponed, an amount equivalent to such tax liability should be debited to P&L account and deferred tax liability account is created. What is the meaning? If tax liability is postponed means under the Income Tax Act I am not paying now. Under the Income Tax Act I am not going to pay full amount. Okay, that is called postponed. Got it or not? So I am paying less under the Income Tax Act and I will pay more in future. Presently I am paying less and I will pay more in future due to the timing difference in the provisions, income tax provision. So that is what they said, save now and pay later. Meaning I am paying less now and I have to pay more in future. So in such case I have to create deferred tax liability account. How to create that? We will work out. And also the next thing is, if tax liability is paid in advance, an amount equivalent to such tax liability should be credited to P&L account and deferred tax asset account is created. So here what they did is, deferred tax liability is paid in advance means they are paying more presently. And they will pay less in future. Under the Income Tax Act, to this we are I'm saying no more less to adjust this more less effect to bring the exact effect. That's why that is the job of deferred tax. There should not be more or there should not be less. What is actually paid, what is actually payable, that effect should be bring back to the financial statement. That is the job of deferred tax. There should not be more or less. Why? Because matching concept is not followed. If it is more also, then also matching concept is not followed. If it is less also, then also matching concept is not followed. When matching concept is followed, what is my profit on which what tax I have to actually pay? On which what is my tax amount? That matching concept is ordered only by identifying or adding the deferred tax portion. Then only that matching concept is complied. That is the reason of deferred tax. Okay, we will understand by going through the problem. We will understand. Okay, what is how to create deferred tax asset, how to create deferred tax liability. We will go through the problems, small examples. You will understand that. Then the final point is in the year of RTD, that is in the year of reversed timing difference. Correct? Reversed timing difference, either DTL is returned back to P&L account or the DTA is reduced by debiting to P&L account. This also we will understand. Initially we will give one effect, next year onwards we have to give the reversal effect. Reverse, that is called reversed timing difference. That is called reversing timing difference. That is called RTD. Okay, we will understand by the understanding the problem. So just go through this problem. Just go through from the beginning. Don't go through the answer directly. Just go through the question step by step. What is the first one? First of all, we are going to understand creation of detail, deferred tax liability. Okay, deferred tax liability, under that cost of assets purchased how much? Cost of asset purchased how much? 100 crores, correct? And depreciation rate as per books, that is depreciation rate as per GAAP, generally accepted accounting principle. Depreciation rate as per Companies Act, 20%. Assume depreciation rate as per Companies Act is, that is books as per books is 20%. And depreciation rate as per Income Tax Act is 100%. Okay. Then what is the next item? Profit before tax 100 crore. This is the question. We have to create deferred tax liability. Okay. So cost of asset is given 100 crores. Depreciation is 20% as per Companies Act, that is as per books 20%. As per Income Tax Act, depreciation is 100%, and profit before tax of this company is 100 crore. This is the question. For this, we have to identify creation of detail, deferred tax liability. So, for this purpose, that profit before tax, you assume that is profit before depreciation and tax. Okay. In question, it is mentioned as profit before tax. You just assume that as profit before depreciation and tax. Profit before depreciation and tax is how much? 100 crore. Okay. Year 1 particulars. I am just writing the particulars. Year 1, year 2, year 3, year 4, year 5. 5 years. Totally I am writing for 5 years. Don't read the answer fully. Just follow my words. Particulars year 1, year 2, year 3, year 4, year 5. Okay. On that first amount is PBDT. That is profit before depreciation and tax. That is 100 crore, 100 crore, 100 crore, 100 crore. For all the 5 years, assume it is 100 crore. For all the 5 years, assume it is 100 crores. I am preparing P&L. I am preparing the P&L account now. I am preparing the P&L account as per the Companies Act. Okay. I am preparing the P&L account as per the Companies Act. So PBDT is arrived 100, 5 years. What is the next item? Less depreciation as per the Companies Act. Less depreciation as per the Companies Act. What is the amount? 20% depreciation on asset 100 crore. 20% depreciation on asset 100 crore. Then how much? Straight line method. Assume it is straight line method. Okay. So 100 into 20%. 100 into 20%. 20 lakh. 20 lakh, 20 lakh, 20 lakh, 20 lakh. So 5 years, 20 lakh, 20 lakh, 20 lakh, 20 lakh, 20 lakh. So I arrived the profit before tax figure. I arrived the profit before tax figure. Profit before tax figure is how much? 80 crore, 80 crore, 80 crore, 80 crore, 80 crore. Profit before tax is how much? 80 crore. So profit before depreciation and tax 100 crore on this 100 crore, 100 crore, 100 crore. Provided book depreciation 20, 20, 20, 20. Provided. Why? Because SLM Companies Act provided it. Then profit before tax, that is after depreciation, you are getting 80, 80, 80, 80. 5. We have got it. Okay. Then what is the next item? We have to make provision for taxation. We have to make provision for taxation. How to calculate provision for taxation? Provision for taxation is on tax on accounting income or tax on taxable income. Provision for tax is on arrived by applying tax on accounting income or tax on taxable income. It is arrived by tax on taxable income only, not on tax on accounting income. So here the profit before tax 80, 80, 80, 80. This is accounting income. This is what actually accounting income. But provision for tax is always arrived on taxable income. Remember your business or profession. Business or profession. Net profit as per P&L account is the opening balance. Then we have to do lot of adjustment. Then we will get the net profit as per Income Tax Act. That is taxable income. Okay. So here also you have to identify what is taxable income. Provision for tax 50, first year nil, second year 50, third year 50, fourth year 50, fifth year 50. How it is arrived? Go to the next slide. We'll go to the next slide. Just look at here. Just look at this workings. Just look at this workings. Just look at this workings. What is in previous slide what we did actually? Previous slide, what is our profit before tax amount? That is accounting income. Accounting income. Net profit as per P&L is how much? Profit before tax. Net profit as per P&L is how much? 80, 80, 80, 80, 80. That is net profit as per P&L account. Correct? Then add disallowed expenses. Add disallowed expenses. That is add depreciation under the Companies Act. Book depreciation. That is book depreciation. Add book depreciation. 20, 20, 20, 20. Why I am adding? Because that is depreciation calculated under the Companies Act. That is depreciation calculated under the books of accounts. Okay. Then less allowed expenses. That is depreciation calculated as per the Income Tax Act. What is the depreciation rate as per the Income Tax Act? Go to the previous slide. Just refer the previous slide. What is mentioned here? What is the depreciation rate? Depreciation rate is how much? 100%. 100%. What is the cost of asset? 100 crore. 100 into 100%. 100 crore is my depreciation. That should be my depreciation here. Correct? So my profit before tax is 80 crore. My profit before tax is 80 crore plus 20 crore depreciation. 80 crore plus 20 crore equal to 100 crore. Correct? Minus 100 crore. Minus 100 crore is IT depreciation. Equal to taxable income how much? Nil. 80 plus 20 minus 100 equal to 0. Taxable income is 0. Then my provision for taxation is nil. Then my provision for taxation is nil. Correct? Similarly for second year. What I did? Just go through the second year figure. Profit before tax 80 crore. Then again I am adding my book depreciation disallowed. Again I adding my book depreciation disallowed. Less IT depreciation how much? Nil. Why IT depreciation is nil? Because 100% is claimed in first year itself. 100% is claimed in first year itself. So no depreciation for the second year, no depreciation for the third year, fourth year no depreciation, fifth year no depreciation. Because all the depreciation figure is claimed in first year itself. Then what is my taxable income for second year? 100 crore. What is my taxable income for third year? 100 crore. What is my taxable income for fourth year? 100 crore. fifth year 100 crore. Then on which provision for tax is how much? What is the rate of tax? 50 percentage. So 100 into 50 percentage, 50 50 50 50. Okay, you got it? So this is how provision is arrived. Provision for tax is arrived. This is called current tax. This tax is called current tax. This tax is arrived based on the taxable income. This tax is arrived based on the taxable income. This tax and the minimum alternative tax both is arrived based on the income tax provisions, not based on the generally accepted accounting principles. MAT is also applied on book profit actually. That book profit is arrived based on the income tax provisions only. Okay. So, and also the rate of tax is also available in income tax provision only. Okay. So, the point is here, this is my taxation. Just we'll go to the previous slide. So, up to 50, 50, 50, you should understand. So, here, if you go through, now just look at my provision for taxation alone. Now, just look at the provision for taxation alone. Provision for taxation. First year nil, second year I am making provision 50 crores, third year I am making 50 crores, fourth year I am making 50 crore, fifth year I am making 50 crore. Correct? Then profit after tax, but before deferred tax. Profit after tax, but before adjusting the deferred tax. What is my profit for the first year? Profit after tax is 80 crore, second year 30 crore, fourth year 30 crore, fifth year also, third year 30 crore, fourth year 30 crore, fifth year also 30 crore. That is profit after tax, but before adjusting anything related to deferred tax. Anything related to deferred tax. Then look at my less deferred tax liability, OTD. Less deferred tax liability, OTD. What is OTD? Originating timing difference. That is the first year this provision, because of this provision I am giving the effect for my deferred tax. That is 40 negative. That is 40 negative. From next year onwards I am doing reversing 10 10 10. Why? What is this workings? We will understand these workings now. So just look at this thing. Continuation. Deferred tax liability, how it is arrived. Due to timing difference, this deferred tax liability is arrived. What is this timing difference? Now look at the first item. First thing is particulars year 1, year 2, year 3, year 4, year 5. Under that book depreciation. What is your book depreciation actually? 20 crore, 20 crore, 20 crore, 20 crore, 20 crore. All the 5 years, 20 crore, 20 crore, 20 crore, 20 crore. Okay. IT depreciation how much? So IT depreciation 100 crore first year. So due to this originating timing difference, actually I have to provide depreciation 20 crore only. But because of this IT Act rules and regulation, I am providing 100 crores in first year itself. Because of this, there is a mismatch between my profit versus tax. There is a mismatch of profit versus tax. Correct? Because it is not matching actually. Because I am claiming excess expenses. I am claiming excess expenses, huge expenses in first year itself. Okay? Because of income tax provisions. Because of income tax provisions. So 20 crore is my book depreciation in first year. IT depreciation is 100 crore. Originating timing difference is how much? 20 minus 100 difference is how much? 80 crore. 80 crore is the originating timing difference on which 50 percentage. 80 into 50 percentage how much? Tax rate is provision for tax rate is how much? 50 percentage. 80 into 50 percentage 40. This 40 is my deferred tax liability. This 40 is my deferred tax liability. What is this deferred tax liability? What I am going to do? I am going to account it as an expenses. I am going to account it as an expenses. Okay? Why? Because consistency, matching concept. Consistency and also matching concept. Matching concept is not followed. I am bringing that matching concept now. if assume if there is no IT provisions or if there is no timing difference in the IT provision, actually my profit will be how much? 80 crore. Actually my profit will be how much for the first year? 80 crore. How? My profit before depreciation and tax is how much? 100 crore. And what is my depreciation? 20 crore. 100 minus 20. Actually my profit how much? 80 crore only. On which how much I would have paid tax? 40 crore I would have paid, but I did not pay any tax on the first year. Why? Because timing difference. Now I am just adjusting the timing difference. Okay, how I am adjusting? 40 crore liability I am creating. 40 crore I am debiting to P&L account, I am creating as a deferred tax liability on the first year. Now I will go back to the previous slides. Just look at here. Profit after tax. After that you look at profit after tax less DTL. OTD. OTD means first time this timing difference is occurred. Originating, initial timing difference. First time the timing difference is occurred. 80 is my profit minus 40 crore deferred tax liability. Minus 40 crore deferred tax liability, then add nothing, then how much you are getting? Profit available for distribution. How much? 40 crore. Profit available to equity shareholders is neutralized now. It is 40 crores for the first year. Come to the second year. How to calculate second year? Look at the second year. Second year what happens? What is my book depreciation? 20 crore. But IT depreciation is how much? Nil. There is no originating timing difference. We have to give the reverse timing difference. Reverse timing difference is for what is given for originating timing difference, on which reversely we have to give the timing difference now. Okay, reversely we have to adjust. Thing is, initially we debited P&L account for 40 crores. Okay, that is due to difference between book depreciation and IT depreciation. In year 2 there is no originating timing differences. So what we have to do is reverse timing difference here. Just to go through 20 crore is my reverse timing differences for the second year. Again 20 crore is my reverse timing difference for the third year. 20 crore is my reverse timing difference for the fourth year. Fifth year 20 crore is my reverse timing differences. Okay. So book depreciation is provided in second year. There is no book depreciation. IT depreciation is provided in the second year. Similarly third year book depreciation is provided. No IT depreciation is provided. Expenses is there, no expenses in IT depreciation. So whatever we created already originating timing differences, we have to give reverse effect now. How we have to give reverse effect? Just apportion the expenses. Like you see 20, 20, 20, on which 50 percentage. On which 50 percentage is how much? 10 crore, 10 crore, 10 crore, 10 crore. This should be credited to P&L account. This should be credited to P&L account means your expenses is reduced, your tax expenses is reduced. Just now you go through this thing. Just refer year 2, year 3, year 4, year 5. Just refer profit after tax first. What is my profit after tax figure for year 2? 30 crore. What is my profit after tax figure for third year? 30 crore. Fourth year 30 crore. Fifth year 30 crore. So, and what I'm doing a reversing the timing difference which is already originated. Now which is already occurred. Now I'm reversing whatever the 40 crore I debited in first year is reversed in every year in a equal proportion. Okay. So what is the reversal in second year? 10 crore. Because of reversal, what happened? 30 plus 10 equal to profit available to distribution how much? 40 crore. Third year what happened? 30 plus 10 equal to 40 crore. Then 30 plus 10 equal to 40 crore. Then again 30 plus 10 equal to 40 crore. So what? So 10 plus 10 plus 10 plus 10, 40. Initially it is debited and now it is credited on yearly basis 10, 10, 10, 10. Initially 40 crore is debited. Now it is credited to my P&L account. This is what deferred tax liability. Initially I am accounting as an expenses in my books of accounts and creating a liability and I am presenting in my balance sheet. Every year from balance sheet I am reversing and transferring to my income account. Every year I am transferring, I am crediting to the P&L account. Okay, 10, 10, 10, 10. This is what creation of DTL. Okay. Now we will understand the creation of DTA. Next thing is We'll understand creation of DTA. So creation of DTL is when you pay less in the present year and you will pay more in the future year. Correct? That case you have to create DTA. But in case of DTL, that case you have to create DTL. But in case of DTA, DTL is deferred tax liability that you will be created when you pay less in the present year and you have to pay more in future year. But in case of DTA, deferred tax asset, when you pay more in the present year and you have to pay less in future year. Okay? Assignment of deferred tax. Assignment of deferred tax asset. Just question you just go through. Assignment of deferred tax assets. Under that, profit for first year and second year is equal to 100 crore. For profit for the first year is also 100 crore. Second year is also 100 crore. Then interest on loans. Interest is paid each year. How much? Interest payable each year. How much? 10 crore each. Okay. First year interest amount paid only in second year along with the second year. Along with the second year, first year interest amount is paid. So what is the next thing? Rate of tax is 50%. So this is the question. So profit is 100 crore. Interest is 10 crore per annum. Profit is also 100 crore per annum. First year, second year, 2 years totally. Interest is also 10 crore per annum. And what is the question is? First year interest amount paid only in second year along with the second year. Rate of tax is 50%. So what they are trying to say? Remember the intersection. Remember 43B under the Income Tax Act. As per the 43B Income Tax Act, interest will be allowed as an expenses only it is actually paid. Interest will be allowed as an expenses only if it is actually paid to the bankers, financial institutions. So here in this question what happens? First year interest is not paid in the first year itself. It is paid only in the second year. So first year the interest expenses is disallowed. It is allowed as an expenses only in the second year as per the Income Tax Act. Okay. With this knowledge we have to approach this question. So example creation of DTA. Just go through the step by step. Don't read the answer fully. Just go through the answer step by step. So what is the first thing? Particulars. Year 1, year 2. Particulars. Year 1, year 2. So under that, what is the first thing? Profit before interest and tax. Profit before interest and tax how much? Profit before interest and tax how much? 110. Why 110? Because profit is given as 100 crores there. In question if you go through, profit is given as how much? In question if you go through, profit is given as 100 crores. Okay. Now we are arriving profit before interest and tax. That is 100 plus 10. 100 plus 10 is 110. Okay. 100 plus 10 is 110. That is what? Profit before interest and tax. So 100 crore, 100 plus 10, 110. Year 1, year 2. Then what is the next item? Less interest. We are preparing financial statement. Schedule 3. Assume it is a schedule 3. We are preparing financial statement. So 110 minus less interest 10. How much is the answer? Profit before tax is how much? 100 crore. 100 crore is the answer. Provision for tax at 50%. 100 into 50%, 50 crore will come. 100 into 50%, how much will come? 50 crore will come. But actually how much is there? 55 is there, 45 is there. Why there is a difference? Because of Income Tax Act. Because of timing difference. Because of provision impact. So provision for tax is calculated on what amount? Accounting income or taxable income? It is calculated on taxable income. So we have to identify taxable income on which we have to calculate provision for tax. That provision for tax we have to present here. Because of that reason only there is a difference. Because of that reason only deferred tax is introduced. Okay. So just we have to identify how this provision for tax is calculated. Just refer the next thing. How this provision for tax is calculated. Just go through. Profit before tax. Profit before tax, how much? Profit before tax, how much? So the profit before tax is 100 crore for the first year. Second year is also 100 crore. That is after adjusting all the interest. What is the leftover is profit before tax 100 crore, 100 crore. First year what I am doing? Add provision for interest. Add provision for interest. Why I am adding? Adding means I am disallowing the expenses. Adding means amount is disallowed under the Income Tax Act. Under the business or profession, the interest is disallowed because under section 43B, the actual payment if only the actual payment is made, then only that is allowed as an expenses. Here year 1 amount is paid only on year 2. So in year 1 it is not allowed as an expenses. So 100 plus 10 equal to 110. 100 plus 10 equal to 110 is my taxable income. 100 plus 10 equal to 110 is my taxable income, on which I am calculating my tax. Tax at 50% how much? 110 into 50% equal to 55 rupees. So 110 into 50% equal to 55 rupees. That is my provision for taxation. That is my provision for taxation. That is what I presented there. Come to the second year. Second year is also my profit is 100 crore. Profit before tax is 100 crore. Whether I am adding provision for interest? No. Why? Because there is no late payment. First year what happened? First year interest is paid only in second year. But second year interest is paid in second year correctly. Second year there is no delay. So there is no impact. You got it or what I am saying? Second year interest is correctly paid in second year itself. So there is no disallowance. So we need to add back anything. Then you arrive something 100. Then what happened? Less payment made in second year. Payment made in second year. So this payment made in second year belongs to first year interest. That is what I have not paid in my first year, I paid in second year. That is 10 crore, correct? That 10 crore is an expenses in second year only. That 10 crore is allowed as an expenses in second year. Because of that reason, 100 minus extra 10 crore. 100 minus extra 10 crore. Why that extra 10 crore? Because that extra 10 crore is basically first year interest. I have not paid in first year, so it is disallowed. Now it is paid in second year, so it is allowed as an expenses. So my profit is reduced. 100 minus 10 equal to 90 crore. That is my taxable income. Okay. On this taxable income, 50% is my profit. Sorry, 50% is my provision for taxation. So tax at 50%. 90 into 50% is 45. So this is what provided there. If you go through here, up to provision for taxation, you please go through. Profit before tax 100, profit before tax 100, on which provision for taxation how arrived 55. Second year 45, just now we discussed how it is arrived. Then we have to give the deferred tax effect, because there is a timing difference. Due to this, we have to create a deferred tax asset. Okay. How to create the deferred tax asset? That we will go through now. Just refer it. So just refer the second table. Okay. Under the second table, what happens? Particulars year 1, year 2. Under that, just refer the year 1. Interest as per books how much? 10 crore. But interest as per tax law how much? 0. Why 0? It is disallowed in the first year. Interest as per books how much? 10 crore. Interest as per tax law 0. Why? Because it is disallowed in the first year. So OTD, originating timing difference. This is called originating timing difference. Initiation, the beginning. Okay, first year impact 10 crore. 10 crore because of this interest is not paid in the present year, because of this interest is not paid in the, not considered as an expenses in the present year, my taxable income will be more in the present year. My taxable income will be more in the present year. I will pay more tax. I will pay more tax in the first year and I will pay less tax in the second year. That is why 55-45. You refer above table. That is why it is called 55-45. Tax at 50%. Just refer 55-45. Why? Because deferred tax. Because I am not allowing the expenses. So here what happens? I am paying more tax in the first year and I am going to pay less tax in the second year because of this timing difference. So I have to create deferred tax asset in this case. Deferred tax asset. To neutralize my P&L, I have to create this deferred tax asset. Okay. So how to create that? Interest as per books is 10 crore. OTD is 10 crore. Tax on above. Tax on above means 50%. 10 into 50% is how much? 10 into 50% is how much? 5 crore is my deferred tax asset created in the first year. It should be credited to my P&L account initially. It should be credited to P&L account and it should be presented as a DTA. Okay? Should be credited to my P&L account. It should be presented as a DTA in the first year. Next year what happens? Interest as per books, interest as per tax law 20, and RTD. RTD is about whatever we gave previously originated timing difference. On that we have to give some reversal effect. Initially we allowed 10, we created OTD 10 crores. Now we have to reverse that 10 crore. Initially we created 10 crore, now we have to reverse that 10 crore. Next year, second year, because that 10 crore is allowed in the second year. So I am reversing now 10 crore. So 10 crore into 5 into 50%, 5 crore. This should be debited to P&L account in the second year. First year credited, second year debited. So my P&L account is neutralized. So now you go to my P&L account. You will understand. So this is what I am trying to explain. Just refer first year. What happened in first year? Add DTA. 5 crore is added, credited to my P&L account. What is my profit available to shareholder? 50 crore. Neutralize. I am getting the even profits. I am able to match my revenue versus profit properly. I am able to match my revenue versus profit due to my deferred tax and liability. What happens in second year? I am writing off the DTA which is created in the first year. So second year what I am doing? Just reducing, debiting my P&L account 5 crore. Okay, and profit available to shareholder is 50 crore. This is what deferred tax assets under deferred tax liability. Okay, so we'll proceed further. Recognition of deferred tax asset. This is one more topic. Recognition of deferred tax asset. You can ask me a question. What is deferred tax asset? What is deferred tax asset? Initially what we are doing in deferred tax asset? Initially we are crediting during originating timing differences and we are reversing in the subsequent year. Reversing means what? We have to debit our P&L account. Initially we are crediting and reversing means subsequently we have to debit our P&L account. Correct? Initially crediting, subsequently debiting. Debiting means we have to debit our P&L account. When we will debit our P&L account? If we have profit only, we will debit our P&L account. Correct? Correct or not? If we have a profit, then only we can write off this tax. Then only we can charge off this tax. Correct? If we don't have profit, how can we charge off this tax? That is called recognition of deferred tax asset. We should have there should be some certainty in estimating our future revenue. Got it or not what I am saying? Initially we credited our P&L account and expecting that in future we will debit our P&L account. When we will debit our P&L account, you should have revenue. If you have a revenue, then only you will get profit. If you have a profit, then only you can debit this deferred tax asset. Correct or not? So when we are creating this deferred tax asset, you should be able to predict your future also. Yes, I am going to generate revenue in my future, so that this deferred tax asset can be charged off or debited to my P&L account in future, because I'll have some profit, because I will generate sufficient revenue on which I will get sufficient profit on which I can debit this deferred tax asset. Got it or not? Because accounts is prepared on conservatism. Conservatism means you have to account all your losses. Only if revenue is certain, then only you have to recognize. But loss, you have to record all your losses and expenses. But revenue is accounted only there is a certainty. That is why recognition of deferred tax asset. What they are trying to say here? Deferred tax asset should be recognized and carry forward only to the extent there is a reasonable certainty that sufficient taxable income will be available in future against which deferred DTA can be realized. If there is no income in future, there is no profit in future. If there is no profit, then I cannot debit my P&L account for this DTA. There should be some profit on which I can debit these expenses. Correct or not? If there is no revenue, there is no profit. Then I cannot debit my P&L account. So when I am creating OTD, that is originating timing difference, that time itself I am able to predict my future, that I have some reasonable certainty that I am able to generate revenue in my subsequent years. Subsequent years I am able to generate revenue. That is called reasonable certainty. How this reasonable certainty, sir? How can we identify this? That is based on the judgment, but is based on the professional judgment. Professional judgment based on the orders we got, based on that we can do this reasonable certainty. Okay. This is one important point while creation of deferred tax asset. But for deferred tax liability, this problem will not be there. Then what is the next thing? In case of unabsorbed depreciation or carry forward losses under the Income Tax Act, if the timing differences due to unabsorbed depreciation and Income Tax Act and carry forward loss Income Tax Act then reasonable certainty is not enough. Virtual certainty is required. Virtual certainty means I should have some evidence in my hand. Yes, I am going to generate profit in my future. I am going to generate revenue in future. You got it or what I am saying? What evidence, sir? How can I get that evidence? For example, you got customer lot of customer order for your future business. You have an order in your hand. Yes, second year I am going to do this much business. Third year I am going to do this much business. That order you can show it as a proof. That is virtual certainty. Evidence in your hand, documents you should produce to recognize deferred tax asset arised due to unabsorbed depreciation or carry forward losses. Okay, this is one point actually. And the next thing is disclosures. So before disclosures, we will work out a few problems from your material and past examination questions. Then we will proceed with the disclosures. Okay. So just go through the so this is the problem from your material. Just go through the question. You can expect objective type questions from this topic actually. They asked around 3 to 4 times in examination already, this type of question. Just go through the question alone. So what is the question? From the following information for all limited for the year ended 31st March 2016, calculate the deferred tax asset liability as per AS 22. This is the question. We have to calculate whether there is a deferred tax or a liability is there for as per AS 22 or not. Okay. Accounting profit, that is accounting income, calculated under the financial statement. Okay. Arrived based on the financial statement, arrived based on the GAAP, generally accepted accounting principles. Book profit as per MAT is given. You should have some basic knowledge about book profit and MAT also. Okay. Profit as per Income Tax Act 1 lakh. Book profit is 9 lakh. Income Tax Act profit is, that is taxable income is 1 lakh. Tax rate is 30%. MAT rate is 10%. So generally MAT and income tax, both are similar, and both are if you pay more tax, if you pay extra tax in MAT, then next year you can take credit of that MAT while paying your income tax act. So you need not to confuse between deferred tax and the MAT. MAT is an additional tax over the income tax. Okay, MAT is an extra tax over the income tax act. That extra tax will be adjusted in future income taxes. Okay, that you have to go through your MAT subject in under the income tax act. You will get to know. But don't confuse deferred tax and MAT. You have to compare deferred tax and income tax only. Okay. Now with the help of this, accounting profit is given, book profit is given, we have to work out the answer. So first point is accounting profit is nothing but accounting income. Accounting income, how much? $10 lakh, and taxable income, how much? Taxable income is 1 lakh, and book profit for MAT purpose, minimum alternative tax, how much? 9 lakh. Okay, so usually we have to compare accounting income versus taxable income. Whatever the MAT comes should be an excess tax over the current tax. Okay, your tax expenses equal to current tax, that is tax calculated based on Income Tax Act, IT Act. Okay, plus deferred tax plus excess of MAT over current tax. Okay, so what I am going to do, accounting income 10 lakh, tax rate 30% only I have to apply. Okay, and taxable income how much? 1 lakh. On that also taxable income 30% only I have to apply. Book profit is an alternative tax method under the Income Tax Act. Separate rate of tax will be given, on which 10% I have to apply. Okay, so as per accounting income, what is my tax? What is the tax I have to pay? 3 lakh. As per taxable income, what is the tax I have to pay? 30,000. As per the book profit, what is the tax I have to pay? 90,000. Okay, so what is my tax expenses here? So logically you should try to understand. Logically you have to understand. Actually I have to pay 3 lakh rupees tax as per the accounting income, but I am paying 30,000. This is income tax, IT, this is accounting income. Tax on accounting income, tax on income tax act. Actually, I have to pay 3 lakh rupees, but I am paying only 30,000 rupees. That is, I am paying less now and I have to pay more. Save now, pay later. Save now, pay later. Correct? Save now, pay later concept. If it is the save now, pay later means, then I have to create DTL, deferred tax liability. I have to create the deferred tax liability. Okay, how much I have to create? Difference, I have to pay 3 lakh, but I am paying how much? 30,000 only under the income tax act. Save now, pay later, meaning I am paying less in income tax now, future I will pay more. That means how much I am paying less? 2,70,000. This is my DTL. Save now, pay later. Under the income tax, I am saving the income tax now and I am going to pay later. Actually, I have to pay around 3 lakh, but I am paying only 30,000. Okay? Because of that, I am creating deferred tax liability. Because of that, I am creating deferred tax liability. Deferred tax liability means I am debiting my P&L account for 2,70,000. This is one thing. This is one thing. 2,70,000 is my deferred tax liability. One more concept, MAT, minimum alternative tax. What is a MAT actually? 90,000. Correct? That's what we arrived, correct? Just refer here. How much we arrived? Book profit, MAT 9 lakh into 10%, how much? 90,000 we have to pay under the MAT. But as per the income tax act, how much we are paying? 30,000 only. So excess over income tax act. 90,000 minus 30,000. The 60,000 also we have to pay under the income tax act. This is, you forgot about for calculating the deferred tax. This is only a relationship between minimum alternative tax versus income tax act. That is an internal adjustment will be happening. Okay, as per that act. Don't confuse with the deferred tax. Deferred tax you should calculate with the accounting income versus taxable income. Book profit, MAT is arrived based on the book profit. You should ignore the book profit for calculation of deferred tax. Okay, so what I am trying to say here, what is my actual tax? Current tax 30,000 calculated under the IT Act. Then deferred tax 2,70,000. Okay, for matching concept, I am arriving this figure. I am matching my profit and I am creating adequate liability, or I am creating adequate expenses based on my profit, and I am creating adequate tax liability based on my profit. Okay, last one is MAT, minimum alternative tax. How much excess? That is excess over. How much is excess? Just refer the excess here. 90,000 is my MAT amount. Actually I am paying 30,000 only under the income tax act, but I have to pay minimum this amount. Minimum tax I have to pay this much, 90,000, but I am paying only 30,000. So extra 60,000 I have to pay. Extra 60,000 I have to pay. My total tax expenses to be debited to P&L account is, my total tax expenses debited to P&L account is 3 lakhs, totally 3,60,000. This amount should be debited to P&L account. Okay, so this is what the answer. Deferred tax should be compared with the taxable income, not book profit. Okay, MAT is an payable only if there is an excess tax over the current tax. For example, now in this question, assume in this question MAT is only 20,000. Assume in this question MAT is not 90,000, it is only 20,000. Assuming this question MAT is only 20,000. What is my existing tax? 30,000. Then a negative 10,000 will come. Then MAT you need not to pay anything. Then you need not to pay MAT anything. Only if it is an excess over your income tax, then only you have to pay MAT. Okay? If MAT is less than your income tax amount, then you need not to pay anything on MAT. You have to pay on your Income Tax Act. This is for MAT or income tax. You have to study the income tax provision, direct tax provision. Then only you can understand. Okay? Go to the next question. So next question is the same thing is given in our material actually. Same answer is given. Next question. What is the next question? Z Limited has provided depreciation as per accounting records 40 lakhs, but as per tax records 60 lakhs only. So as per books depreciation is 40 lakhs, as per tax depreciation is 60 lakhs. Okay? More depreciation is provided in Income Tax Act. And what is the next amount? Next item. Unamortized preliminary expenses as per tax record. Unamortized preliminary expenses as per tax record 20,000 rupees. Okay? There is adequate evidence of future profit. There is adequate evidence of future profit sufficiency. How much deferred tax asset liability should be created as transition adjustment? Tax rate 30%. So what is the question? 40 lakhs depreciation as per books, 60 lakhs depreciation as per income tax record. More expenses or less expenses? Tax in income tax, whether it is more expenses or less expenses? More expenses is in income tax, correct? More expenses in Income Tax Act. If you have more expenses in Income Tax Act, you will pay less tax or more tax. If you have more expenses, your profit will be less. Your profit will be less, then you will pay less tax. If you pay less, then you have to pay more in future, correct? If you pay less now, you have to pay more in future, correct? That logic you have to apply. Actually, that logic you have to apply. Now we will work out the problem. Then what is the next item? Unamortized preliminary expenses as per tax record is 20,000 rupees. So what is the meaning of this one? Unamortized expenses, preliminary expenses will be allowed phase wise actually. In company accounts, in accounts prepared under the financial accounts prepared as per GAAP, generally accepted accounting principles, all the expenses is allowed in the first year itself, but as per Income Tax Act it will be allowed phase wise. Okay, with this logic we have to approach this problem. First we will understand the depreciation part, then we will understand the preliminary expenses part. Okay, so what they are trying to say? Books depreciation 40 lakhs. IT depreciation 60 lakhs. Because of this, whether I will pay more tax or less tax under the Income Tax Act, that thinking you should be able to make first. My expenses is more in Income Tax Act and less in my Companies Act, correct? If my expenses is more, then my profit will be less, correct? Then I will pay less tax, correct? If I pay less tax, then that is save now, pay later. Then I need to create deferred tax liability, correct? To neutralize the profit, to neutralize my taxation, I have to create my deferred tax liability. Book adjustment, I have to do the book adjustment. This is one aspect. Another aspect is, for this thing I have to create deferred tax liability. First item, I have to create deferred tax liability. Second item, unamortized expenses. Unamortized expenses rupees 20,000. What is the meaning of unamortized expenses? This expenses will be treated as an expenses as over the period in Income Tax Act. Over the period in Income Tax Act. You got it on what I am saying? This expenses is treated as an expenses over the period in Income Tax Act. For example, in books of accounts, that is company accounts, books of accounts, this 20,000 is already debited. Already debited to P&L account. But Income Tax Act, but IT not debited. Okay, books of accounts 20,000 is already debited. Books of accounts is this is an 20,000 is already accounted as an expenses, but in Income Tax Act it is not yet accounted as an expenses. Assume in OTD, what would have happened? OTD means original timing difference. Originating timing difference. What will happen? Books of accounts expenses is more. Books of accounts, what would have happened? Expenses is more, and books of accounts, this is my books of accounts, Companies Act, okay, accounting income. And what will happen in my IT Act? Expenses is less, because I did not made an expenses, because I am amortizing. I am not accounting all the expenses in the first year itself. I am amortizing these expenses. What would have happened in this case actually? First year I did not made any expenses. First year I did not made any expenses. Now, just now I am making action expenses. First year what I would have done it? First version what I would have done it? First year expenses is more in books of accounts and expenses is less in my IT account, correct? So I would have paid less tax in my income tax, and I would have paid, and I would have created DTL initially, and I would have created DTL initially, that is OTD, okay? OTD already created, DTL is already created. Now actually what happens, we have to do RTD. We have to do RTD, that is writing back. So now we have to do RTD. RTD is reversing timing difference, 20,000 rupees. 20,000 rupees already accounted in OTD, that is initial originating timing difference. It is already DTL is created. Now we are writing back. That means we have to do the reverse. Means we have to write back. We have to reduce the from our DTL. Correct? We have to credit to our P&L account. So what they are doing here is depreciation, originating timing difference. Originating timing difference due to depreciation equal to rupees 20 lakhs. Okay, this is originating timing difference, first time happening, minus RTD due to due to writing back DTL. Due to writing back DTL, that is 0.2 lakhs. That is 20,000 is 0.2 lakhs. So DTL 20 lakh is created, RTD, that is reversing effect we are doing. So 20 minus 0.2 equal to 19.8 lakhs. Okay. Unamortized expenses means it is already accounted as an expenses in my financial accounts, in my accounting, in my books of account. It is already accounted as an expenses, but it is not accounted as an expenses in my income tax act. Now I am accounting as an expenses. That means I would have created deferred tax liability. Now I have to write back that. So that is why I am reversing this 0.2 lakh. So 20 lakh is OTD, that is just this year new fresh one, and RTD is already created DTL. Now we are writing back. So 20 minus 0.2, 19.8 lakh is my DTL for the year. Okay, this should be debited to my P&L account. This should be debited to my P&L account. Okay. So the next question is OM Limited working on different projects which are likely to be completed within 3 years. It recognizes revenue from these contract on percentage of completion method for financial statement 2015, 16 and 17 for 11 lakhs, 16 lakhs, 21 lakhs. Okay, that is accounting income is 11 lakh, 16 lakh, 21 lakh. However, for income tax purpose, it has adopted the completed contract method, under which it has recognized revenue as 7 lakh, 8 lakh, 18 lakh, 23 lakh for the year 15, 16, 17. Income tax rate is 40%. Assume income tax rate is 35%. Okay, there is an error in the question. Assume it is 40, not 40%, it is 35%. Okay, income tax rate is 35%. So compute the amount of deferred tax assets liability for the year 2015, 16 and 17. So this is the question. So before getting into the answer, you have to understand certain basics. In the same year you will get deferred tax asset, deferred tax liability, both the cases, but the net figure only we have to present in the balance sheet after adjusting the deferred tax assets and liability. The net figure, it may be a deferred tax asset or deferred tax liability. Okay, with this understanding only we have to approach this problem. Just we will work out the problem. I think there is some more explanation is required on the answer side. The material answer is not enough. We will work out our answer. So first thing is tax rate. Tax rate, assume it is 35%, not 40%. Okay, not 40%, 40%, it is 35%. So accounting income, taxable income, tax, deferred tax liability, deferred tax asset, net balance. Okay, net balance, that may be deferred tax asset or liability. So first year, second year, third year. First year as per the question, 11 lakh, 11 lakh or what? Yes, 11 lakh. 11 lakh under the income tax act, sorry, under the accounting income it is 11 lakh, tax taxable income 7 lakh, and second year it is 16 lakh. Under the taxable income it is 18 lakh, and third year it is 21 lakh. Under the accounting income, under the taxable income it is 23 lakh. Okay, difference 2 lakh, sorry, not 2 lakh, 4 lakh is lesser. 4 lakh is lesser in taxable income, and 2 lakh is greater than taxable income. 2 lakh is greater in taxable income. Okay, so tax is calculated on taxable income. Tax is calculated on taxable income. Tax rate I said 35%. Tax rate I said 35%. So 35% tax rate, then we have to calculate deferred tax liability also. Forget about tax thing, forget about taxing, directly we will go to deferred tax liability and deferred tax asset. Now logically you have to understand, accounting income is how much? 11 lakh. Taxable income is how much? 7 lakh. Whether I am paying more or less, whether I am going to pay more tax or less tax. I am going to pay more tax or less tax in first year. I am going to pay less tax in first year. I am going to pay less tax in first year, correct or not? How it is? Because my accounting income net, my accounting income is 11 lakh, but my taxable income is only 7 lakh. Then I will pay less tax, correct or not? What is the difference actually? 11 minus 7, how much? This 4. This 4 lakhs I am paying less tax. On this 4 lakhs I am paying less tax. 4 lakhs into 35% how much? 4 lakhs into 35% how much? 4 lakhs into 35%, 1,40,000. Why I am writing under deferred tax liability? Save now, pay later. For that I am creating deferred tax liability. Why? Because I am paying less tax in income tax. For that I have to set off. For that I have to neutralize the tax. So I am creating liability. I am debiting my P&L account for deferred tax amount and creating this deferred tax liability. So first year is over. First year is over. Okay. Current tax we need not to calculate. Okay. Current tax is not required. Only deferred tax thing is required here. So net balance how much? Net balance 1,40,000 at the year end. 1,40,000 deferred tax liability at the year end. Okay. Then what happens? Second year. Second year accounting income how much? Second year accounting income how much? 16 lakhs. Taxable income how much? 18 lakhs. I am paying more or less? I am paying more or less? I am going to pay more tax. I am going to pay more tax in second year. Okay. I am going to pay more tax in second year. I am going to pay more tax in second year. Because of some income tax reason, I am going to pay more tax in second year. So here what I should do? Here what I should do? I am paying more tax in second year. So I have to create deferred tax. I have to create deferred tax asset. 2 lakh into 35%, 70,000. 2 lakh into 35% is 70,000. 2 lakh into 35% is 70,000. This is one. Guys, just ignore this method and please ignore this method. I will explain with the same problem in another method. Okay. So Just go through this one. Accounting income is 11 lakh. Accounting income is 11 lakh. Taxable income is 7 lakh. Accounting income is 11 lakh. Taxable income is 7 lakh. So difference is how much? 4 lakh rupees. 4 lakhs rupees difference means I am paying less tax in income tax. I am paying less tax in income tax on this 4 lakh rupees because my taxable income is only 7 lakh. So what happens on this 4 lakh rupees? 35% how much? On this 4 lakh rupees, 35% is how much? 1.4 lakh rupees. On this 4 lakh rupees, 35% is how much? 1.4 lakh rupees. For this, I have to create detail. For this, I have to create detail. Deferred tax liability. This is called OTD. Originating timing difference. This is called originating timing difference. This should be debited to my P&L account as deferred tax. And I have to create a deferred. I have to keep this 1.4 lakh in my balance sheet. Under the deferred tax liability category. Okay, under the non-current liability, I have to keep this. Under non-current liability, I have to keep this as a deferred tax liability. Okay, for the first year. I have to keep this figure. Okay. Second year what happens? My accounting income is 16 lakh, whereas my taxable income is 18 lakhs. My accounting income is 16 lakhs, whereas my taxable income is 18 lakhs. 2 lakhs is lesser than my accounting income. I am paying more tax. In second year. Which is nothing but my previous year figure is transferred here. Previous year I paid only tax on 7 lakh. This year I am paying more tax. So this 2 lakh rupees is nothing but previous year what I created as a deferred tax liability should be written back. Should be written back to my P&L account. So 2 lakh into 0.35%. 2 lakh into 35% is equal to 0.7 lakh. 2 lakh into 35% is equal to 0.7 lakh. This 0.7 lakh should be credited to my P&L account. This 0.7 lakh should be credited to my P&L account under the deferred tax liability. Okay, should be credited to my P&L account. Then what is my balance sheet figure? Balance figure. What is my balance sheet figure? Balance sheet opening balance how much? Opening balance is 1.7 lakh. Balance sheet deferred tax liability opening balance is how much? 1.7 lakh minus write back to P&L. How much? 1.7 or 1.4? I think it is 1.4. Yeah, it's not 1.7, it is 1.4 lakhs. Okay, 1.4 lakhs minus 0.7 credited to P&L account. 0.7 credited to P&L account. Then it becomes 0.7 lakhs. My balance sheet closing balance becomes 0.7 lakh. Okay. Then what happened in third year? Again what happens? My accounting income is 21 lakh, but my taxable income is 23 lakhs. I am paying more tax in third year. Why? Because I paid less tax in first year. That is partly adjusted in second year. Now balance is adjusted in third year. So I have to write back my balance detail. This is initially it is called OTD. Here it is called RTD. Second year it is called RTD. Third year it is called RTD. Reversing timing difference. So what I am doing? 2 lakh into 0.35. 2 lakh into 0.35 how much? 0.7 lakhs. 2 lakh into 0.35 how much? 0.7 lakhs. This again I should credit to my P&L account under deferred tax. Credit to P&L account. Deferred tax. Then what happens? Come to my balance sheet. Balance sheet what happens? Opening balance how much? Previous year closing balance, this year opening balance. Previous year closing balance, this year closing balance how much? This year opening balance. 0.7 lakh is my opening balance. Write back how much? Write back during the year. 0.7 7 lakhs. Okay, 0.7 minus 0.7 equal to 0. My non-current liability under the deferred tax liability equal to 0. Okay, you please follow this method. So this is the answer. With this the working part is over. I'll share the question of few problems. You try to work out the answer. I will just share the question, you please try to work out the answer. Okay, just go through the question. Depreciation as per accounting records 30 lakhs. Depreciation as per income tax act 75 lakhs. Unamortized preliminary expenses 4,50,000. Tax rate is 35%. There is adequate evidence of future profit sufficiency. As per AS 22, calculate deferred tax liability or assets. Okay, 4 answer is given. You have to identify which one is correct. You please comment below to the topic. I will share the correct answer later. Okay, this is the question, just note it down. You please try yourself based on our explanation, based on our past problems. You can easily work out this problem. Based on our workings, if you go through our workings properly, you can easily work out this problem. Okay, just note down the next problem. So this is the next problem. From the following details of Zebra Limited, calculate the deferred tax assets and liabilities and the amount of tax to be debited to P&L account. So this is the question. Actually answer is also given here. Just deleting the answer. So this is the question, this is the part answer. Just go through the question. Tax expenses, taxable income they have given 15 lakh, tax rate is 30%, and MAT tax as per income tax is 2 lakh, tax rate is 30%, MAT is 13 lakh 50,000, tax rate is 7.5%. This is the question. We have to work out what is the total tax amount. Okay. So again I am reading. Accounting income is 15 lakh, on that tax is 30%. Then taxable income is 2 lakh, on that 30% tax. Then MAT is book profit is 13 lakh 50,000, on that tax rate is 7.5%. This is the question. You have to identify total tax. Okay. So this is the next question. This is the next question. Just go through the question. Accounting profit rupees 15 lakh, book profit 8 lakh 75,000, profit as per income tax act 1 lakh 50,000, tax rate is 30%, MAT rate is 7.5%. Okay. So what is the solution? 4 answer is given. Out of this 4 you have to choose one answer. 4,95,000 something is given, A, B, C, D. So you have to choose the correct answer and share your answer, and I will confirm whether it is correct or not. Okay. So I have given homework 3 questions. You please work out this 3. This is our 3. All the 3 is based on our workings only, and I'll come to the disclosure part. So disclosures under AS 22. What should be disclosed under AS 22? Simple. What is the deferred tax asset and liability? Breakup should be disclosed. Below to your financial statement you have to disclose this breakup. And also DTA is presented under non-current assets and DTL is presented under the non-current liability. You have to present in this in your financial statement schedule 3. Okay, and finally the secret to getting ahead is getting started. So if you want to reach the success part, first of all you have to start the your studies actually. Okay, so better please start your studies, and definitely you will reach to that success definitely. So with this, today topic is over. So my policy is always talk less, work more. So we will meet in our next class. Okay, thank you.